Hello everyone, this is Chuck Carnival and I'm the Chuck in the Markets Up Chuck. This will be the first in a series titled Popular Stocks, Fast and Fun Analysis. FAST is the Fundamentals Analyzer software tool, FAST graph, and the fun part is the Financial Underlying Numbers fun graphs. Everyone likes to talk about Apple. Apple's one of the most written about stocks. Some people love it, some people hate it. So I thought it might be fun and fast to take a quick look at Apple by the numbers. I will start out by looking at Apple's earnings per share going back to 2001 to illustrate what a powerful growth stock Apple has truly been. Earnings turned from losses in 2001. By the way, their fiscal year ends at September. They earned 2 cents in 2002, went down to 1 cent again, but then since fiscal year 2004, you can see that their earnings growth has been extraordinary. I'll go ahead and shorten the time frame here. Since 2004, Apple has grown earnings by the incredible rate of over 55% a year. From a standpoint of investing results, I thought it'd be interesting before I go any further just to put it into perspective how powerful a growth stock this is. If you'd have put $10,000 in Apple on September 30th, 2003, through yesterday's closing price of $161, Apple would be worth $1,091,892. And as I'll illustrate in a minute, they also would have paid you another $66,000 in dividends for a whopping 40.8% annualized rate of return. Compare that to the S&P 500, which would have generated a 7.9% annualized rate of return. And you can easily see why Apple is such a popular stock. Now, this is earnings per share, and what I have here, this particular graph is drawn at a PE ratio of 55.1, which is equal to the company's earnings growth rate, as you see here. But that's really kind of an impractical growth rate because, as you can see, in more recent years, Apple's earnings growth has slowed down a little bit. So I'm going to drop this to where I'm actually covering 10 historical years and a couple of forecasting years here. And I want you to see that Apple is still growing at over 28% a year. So next, I'm going to add to this particular graph, and by the way, the PE ratio of the orange line, again, equal to the growth rate, is now being drawn at 28. So I'm going to put monthly closing stock prices on the graph, and I want you to notice something very interesting here. You can see that the price has risen in concert with earnings, but at a different rate. And that's where the normal PE ratio comes in. The marketplace since 2008, coming out of the Great Recession, has valued Apple at an average or normal PE ratio of about 17.4. So that's the PE of this blue line. So what you can see here is that when the price is above the blue line, it would be a situation theoretically classified as overvalued. When it's below the line, like the PE got down to 10 in June of 2013, it's undervalued. And right now on this basis for this time frame, it would be theoretically fairly valued or just a tad over fair value based on the normal PE. But I also want you to notice there was a very high acceleration in growth during this period here. So let's drop the time frame a little more and let's draw it now at a 9-year graph. And now the picture begins to change. Earnings growth is 21%. The orange line is still a PE of 20. But Apple was not really traded at that PE. The normal PE for this time frame has slowed down to about 14, and at that level, Apple would be slightly overvalued. But let's look at a couple other metrics here because it's also important to recognize that Apple has also begun initiating a dividend. So let me plot dividends on the graph, and you can see that Apple paid their first dividend in September of 2012. They paid 38 cents for that fiscal year. Then they raised it to $1.64, which was a huge growth rate, obviously. But then they have a normalized growth rate, went to $1.82, $1.98, $2.18, and expected to pay about $2.40. So I want you to notice that Apple's paying out a very small percentage. This area below this white-looking line represents the portion of these total profits that Apple pays out in dividends. And if you go down to that payout ratio, you can see it's in the 25 to maybe even as high as 30% range here, 29, 28, 21, 26. So they're paying out, let's just say, about a fourth of their profits in dividends to shareholders currently. Now, since it started to pay dividends, let's look at Apple from a standpoint of operating cash flows. Operating cash flows have been extraordinarily strong over this time frame. The normal price to cash flow has been about 10, 9.9. It's currently trading at 12.8. So from a cash flow perspective, you could argue that Apple is moderately overvalued, but certainly not dangerously so. And of course, their payout ratio of cash flows is actually lower than earnings at around 15 to 20%. So a couple of things about that. There's a lot of room for Apple to continue to increase their dividend if they so chose. And then I'm going to finally take a look at free cash flow from a cash flow perspective. And you can see that their free cash flow is also very high. The company pays out, again, about 15 to 20% or 22% of their free cash flow. And free cash flow is what's left over after running the business. So the company is obviously a prodigious cash flow generator. The stock looks overvalued on that basis. And then finally, I'm going to take a look at EBITDA here, or earnings before income taxes, depreciation, and amortization, which is another form of cash flow. And I'm going to lengthen this graph again because I want you to see this relationship to EBITDA. That's a little bit too long because I got some aberrant numbers there. You can see that Apple has grown EBIT at about 32.5%. Their normal price to EBIT has been about 13. That's what this orange line, this is a price to EBIT of 13. And so on a basis of EBITDA, on the longer term perspective, they'd be moderately undervalued, but in more recent times, their price to EBITDA has fallen to about 9.5, so they would be overvalued. So Apple is still a strong growth stock. Let's go ahead and look a little bit at the future and look at what forecasting might mean, or what is expected in terms of forecasting growth and how that relates to profitability. So I'm back to operating earnings here, and the consensus of leading analysts expect Apple to grow earnings at about 9.5% over the next couple of years. There are 39 analysts that forecast 8.5% growth for this fiscal year ending September 30th, or really in another month or so. For 2018, they do expect growth to accelerate back up to almost 20%. And then for 2019, 4 and 5%. So growth forecasts going forward are certainly a lot lower than what we've seen historically. Now let's apply that normal valuation multiple of around 13 or 14. And again, if you look at Apple's normal price earnings ratio historically, you can see that its normal PE has been gradually falling as their growth rate has slowed down, because earnings growth is also another consideration here. So let's take a look at historical earnings growth over the last several years. You can see it was in the mid-30s and it got into the teens, and it's still hanging around the teens. So, earnings growth has obviously slowed down. But to go back to that normal multiple and, looking at the consensus analyst estimates going forward, Apple would appear to be moderately overvalued today. Now, not to the point where I'd be interested in selling it, but perhaps to the point where it wouldn't be a great entry point on Apple currently. Now, this video is supposed to be a fast fundamental analyzer software analysis, which I've done, but also a fun financial underlying numbers. I just want to look at a couple of important numbers here on Apple that I think need to be taken into consideration. This is gross and net profit margin. I'm just going to shorten this to the last 10 years. You can see that Apple generates a gross profit margin in the 30 and 40% range historically, and it's pretty much holding that, give or take a little bit each year. Their net profit margins have been solidly in the 20% range historically, and they continue to do that. If we just look at the last 3 years or 12 quarters, you can see that they're maintaining these 38% margins and approximately a 19 to 20% net margin. So margin looks very attractive for Apple still. It continues to generate good margins. Returns on invested capital are dropping a little bit for the last several quarters. But if you look at it from an annual basis, if I can get the graph to change here, you can see that their returns on invested capital have fallen a little bit and are expected to continue falling. But they're still generating very good returns on invested capital. Returns on assets are another issue. Now, there's a couple of other points I want to just cover very quickly here. When you look at Apple from a standpoint of share buybacks, the company has recently been buying stock back, but now that it's becoming overvalued a little bit, or at least moderately overvalued, I hope they quit doing that. But I also want to take a look at cash and cash equivalents. And this is something that's quite interesting about Apple, because this company has an enormous amount of cash. They have billions of dollars of cash on the balance sheet. And how they use that cash has some political ramifications as well as others. But anyway, this has been a fast and fun look at Apple, and I hope it gave you a good perspective on what kind of growth stock this is. It's become a dividend-paying stock. Its earnings growth is obviously slowing down a little, but I still think Apple has legs to it going forward if you can get the right entry entry point. So I might wait for a little pullback before I invested in Apple. I hope you enjoyed this look at the popular stock Apple. This has been Chuck Carnevale saying thanks for watching.